Hello everyone, I'm Vincent and this is Resonanz Spotlight, this podcast where we explore investment strategies, learn the stories behind them, and meet the experts shaping modern portfolios. Today's episode is about QIS, or quantitative investment strategies, but viewed through a slightly different lens. Over the years, this part of the market has evolved significantly in the breadth of instrument, in technology, in access format, and also in the way investors use these strategies within portfolios. And one of the most interesting ways to understand that evolution is through the eyes of someone who sits at the intersection of client needs, research insight, and market implementation. My guest today is Chloi Karyda, Managing Director and Global Head of QS Solutions at JP Morgan. What makes Chloe especially interesting for this conversation is her cross functional vantage point. Her role sits close to the dialogue between investors' objective, the research process, and the realities of trading and execution. That makes her exceptionally well placed to reflect not only on how this market has developed, but also on how investors think about using systematic tools in practice. In our conversation, we will explore that evolution and then discuss a few market environments where these kinds of tools can play a particularly interesting role in portfolio construction. Chloe, welcome to Resonance Spotlight.
Thank you so much. Thank you for having me. I'm very happy to be here.
Great. Thanks. So, Chloe, before we get into the evolution of QIS itself, I want to start with your role and your perspective because you sit in a part of the market where several worlds meet. So first, how do you describe your role to someone outside the GIS world, and what does that role allow you to see about markets and investor needs that others might miss?
My team and I, we sit in the intersection of client and product. So you can really think of my team as an internal task force that works within the bank on behalf of the client. So we know the products, the platform, the capabilities, the technology, the investment formats deeply. And we also really spend real time understanding the needs of investors, understanding their setup, understanding their constraints. And then our job is to marry these two worlds, both before a trade, but also during its life, making sure that we leverage the bank's QIS products and capabilities to meet client needs. And sitting in this intersection means we're in the very fortunate position to have continuous access and dialogue to institutional investors across the globe. We hear their needs, we hear how their views are evolving, we hear their concerns, we hear their constraints. And that puts us in a very unique position to be able to spot trends, to be able to see where the market is moving, to be able to see what more our clients might be needing or missing from the space. And we then very naturally also feed that back into the product development and into the technology and platform agenda so that we make sure that the evolution in terms of capabilities is also always client led.
So, talking about investor needs, when investors come to you, what are they usually trying to solve for, and how has that changed over time?
Yeah, I guess in broad terms, the needs have maybe shifted from just give me a clever diversifier to give me something to solve my specific problem. And that specific problem could be many different things. It could be help me protect my portfolio from inflation. It could be help me hedge my tail risks. It could be help me generate income or find carry opportunities without many directional bets. Or sometimes the problem is not even investment objective led per se. Sometimes the problem is help me access a market that I find very difficult to trade, or help me implement a strategy which I find very operationally cumbersome to run, or help me leverage my internal operational capabilities, help me deploy cash efficiently, help me minimize my margin. I guess there's a broad understanding now that the QIS capabilities and the QIS toolkit can actually be used to solve a very large problem set, which is now far beyond just liquid hedge fund alternatives.
So that broader perspective is a good entry point into the evolution of the space itself. Because when people hear QS, they often think first about strategies. But the story seems much broader than that. Product, technology, format, and use cases have all developed meaningfully over time. So if you step back and look at the broader arc of QS, what do you think has changed most meaningfully over time?
There's definitely been very significant evolution, and I think there's probably three dimensions where we see that most. The first dimension is that there's clearly been significant investment and progress into the product capabilities and QIS platform capabilities themselves. So that could include things like new instruments, new esoteric data sets. It could include new risk management methods, intraday execution, very detailed intraday risk reporting or risk monitoring, very detailed and bespoke analytics and reports and tools that clients can use for managing their trades. So a lot of that is progress that we have seen over the years in the capabilities and in the product space itself. The second element of evolution is what we touched before in terms of the breadth of use cases. So going from just plain diversification to portfolio completion to hedging for particular risks to market access to specific objective driven type of structures. And I think the third dimension of significant evolution, I would maybe characterize as evolution in the collaboration model, if you want. So there's been significant progress and evolution in terms of the platform capabilities and the technology within QIS that now allow for things like strategy co-development, for custom dynamic parameters within specific strategies, for execution outsourcing, which has been very relevant for a client base that is becoming increasingly sophisticated within QIS. It's also been very relevant for opening up the QIS space even to very active asset managers or hedge funds as well.
And how important have access format and implementation choices become in that evolution? And why should allocators care about the dimension as much as the strategy itself?
Yeah, I would definitely say that implementation choices are make or break, and there's really a very important edge that is available from the craft of implementation. There could be two strategies that on paper are very similar, but actually end up having very different profiles just because of implementation calibration. Things like the choice of instruments, things like sizing, things like risk management, things like timing of execution, things like the lag between signal and execution. They really have a real impact in terms of the carry, in terms of the risk, in terms of the drawdown profile, in terms of the rebound after a stress. And it's those implementation processes that really make the difference between the lived experience and the lived risk in a strategy versus the theory of it on paper. So investors should absolutely care about these implementation choices, about these implementation differences, because they really do matter. Now, when it comes to access formats and different investment formats, they are clearly also very important from a different dimension. So implementation formats or the choice of implementation format could actually be making the difference between being able to get internal buy-in and approval to enter into the QIS space versus not. For example, trading some of these structures in a protected loss format could be the only way for an investor with very strict risk controls or risk constraints to be able to participate in the market.
And Chloe, would it be fair to say that QS has evolved from a relatively narrow product set into a more flexible portfolio toolkit? And if so, what drove that shift?
Absolutely, I would definitely say so. I think in all of the dimensions of evolution that we have touched on, if there's one common thread, that is breadth. So the product set has actually become so much broader in all of these dimensions of product, of use cases, of collaboration models. And I think what changed or what has driven this, as always, is quite like multifold. I guess the first thing that has changed is clearly that the space itself has evolved. So technology and investment in technology within QIS has made it so that the value chain of QIS can actually now be decomposed into its modular components, from proprietary IP to data to execution methods to technology, in a way that investors can actually choose the elements that they care about and interact only with those, which is a significant shift. The other thing that has changed is clearly investors themselves. Their understanding of the space is much deeper and their needs are much more complex. And at the end of the day, the banks are simply responding to that.
So, Chloe, let's talk markets and let's start with inflation. Even if inflation is no longer the dominant market headline every day, many investors still worry that it could remain stickier than expected or reappears in way markets are not fully pricing. So, when investors worry about sticky inflation, what is the main portfolio problem they are trying to solve?
Yeah, inflation comes in and out of the picture. And clearly, with the latest moves in energy, it's again front of mind. I think when investors think about sticky inflation, the main portfolio problem or challenge that they're facing is maybe twofold. One is the fact that perhaps correlation structures that they're relying on when putting their multi asset portfolios together might look different in the high and sticky inflationary environment than otherwise expect. The other component of this is that with high and sticky inflation, and perhaps with the possibility of upside inflation surprises, the environment for the rates path becomes much more volatile as well. So, practically, what investors really worry about when it comes to inflation is, have I set up my portfolio in a way where it's not reliant on just one specific correlation environment and it's not reliant on just one specific rates path to work?
And where can a systematic approach be useful here compared with a simpler directional view on rates or inflation?
Yeah, to be honest, I think a systematic approach just allows for a bit more grace in the absence of a very strong directional view, or in the case where a very strong directional view might end up being wrong, or in the case where a very strong directional view might actually be right, but the timing of it is uncertain. And I guess a bit more concretely, a systematic approach would often allow for a convex exposure to things like moves in inflation or moves in rates. And that could be through long volatility trades in the rates space or in the inflation space or in the commodity space. It could be through delta replication. There's a bit more of an asymmetric payoff that you can get through a systematic implementation. The other element of that is that a systematic toolkit gives you many more potentially interesting building blocks that can be combined together in a way that you can still benefit from harvesting premium during range bound markets while still having the reactive and asymmetric protection in the case of
Mhm.
inflation surprises, versus a more directional approach that could actually be quite costly if the realization of the markets is more of a range bound environment for quite some time.
Let's move to equities. A market can have a strong headline themes, but under the surface, it can still behave in a much more uneven way. It's winners, laggards, crowding, and reversal. So, if we take an equity market shaped by a big theme like AI, what makes the opportunity set more interesting than a simple bullish or bearish view on equities?
Yeah, you're absolutely right. It's this, winners versus losers and concentration and potential reversals. That means that the edge is indeed in the micro. So it's about who's deploying capex more efficiently versus who is overbought. So structures that play on the correlation dynamics, or structures that play on factor rotations, might actually present really interesting opportunities that could enhance very significantly the returns and the profiles of a simple up or down view on the index.
How should investors think about the difference between backing the theme itself and taking advantage of the dispersion it can create across stocks?
I think, to be honest, the two are complementary rather than mutually exclusive. I think clients can do both. So you can back the theme through selective tilting towards the stocks or the sectors or the factors that are likely to benefit from AI, resulting in sustainable earnings or sustainable growth in earnings. And at the same time, you can benefit from the dispersion by accessing implied correlation through things like systematic dispersion, targeting that specific part of the market. I would say the two together are actually a very interesting proposition, whereby what you're doing is really coupling like a
Mm.
fundamental tilt view with a market microstructure edge as well.
And then there's commodities. People often talk about commodities as one big asset class, but in reality, the drivers can be very different across energy, metals, agriculture, and the shape of the curve itself. So, why do commodities lend themselves especially well to a more selective, systematic approach?
Yeah, I mean, you're exactly right. I think when we think of commodities, each commodity sleeve is really driven by its own engine, if you want. So you have metals that are clearly much more exposed to things like capex and electrification. You have energy that is obviously very much exposed to geopolitics or supply policies. You have agriculture that is clearly much more exposed to things like inventories and crops and weather. And even if you think at each individual commodity, at any point in time, each individual commodity could be very heavily affected by its own idiosyncratic factors. And then you have the curve component that obviously adds another layer of returns, another layer of opportunities, another layer of risks as well. So, through a systematic approach, what you can actually do is be very direct in terms of targeting these market idiosyncrasies on a commodity by commodity basis. At the same time, target a large universe of potential premium, including things like carry, trend, fundamental value, reversion, where each of these idiosyncrasies is considered on a standalone basis, but the risk is also managed holistically.
And in commodities, why is it often not enough to just have a broad directional view?
I guess, in addition to the often observed dispersion between commodities that we just discussed, even if your directional view on commodities is granular enough to be on a commodity by commodity basis, you might be right on the direction and you might still lose on curve or lose on carry or lose on the curve dynamics. And it could be that there's a shock or a geopolitical event that completely flips the curve quite unexpectedly. So, a systematic approach that actually delineates between the spot element and the curve element and targets a diversified set of premia, including things like carry, trend, value, reversion across both the spot component and the curve component, could actually weather this type of shocks much better than just a directional call on the front month component, even if it's on a commodity by commodity basis. And at worst, it would be complementary to that.
Before we wrap up, I want to come back to the bigger picture. Because what has come true in this discussion is that implementation is not a secondary issue. In many cases, it is part of the investment thinking itself. So, across all of these examples, what do investors still underestimate when it comes to implementation?
Yeah. I think the element that is most at risk of being underestimated, and that's particularly true when investors first start their journey into QIS investing, is the value of internal education that goes far beyond the immediate portfolio management or investment team and really touches all internal stakeholders. Really, what you need is a roadmap that sets out expectations, it sets out the objectives, the risk tolerance, the risk management under different scenarios, the periodicity of reviews, something that is designed for the specific circumstances of the client and is something that the full organization buys into. And it's this discipline that really makes the difference between, a theoretical view on what QIS could offer versus the practical lived experience. And it's also what helps the theoretical or target investment horizon end up being the reality during the life period of a trade as well.
When you look ahead, what do you think will shape the next phase of evolution in this part of the market?
I think the macro environment always has a bearing on what investors will care about. So things like where rates are or the path of rates always has an impact into how important carry and income generation is. Volatility or risks or concentration always has a bearing in terms of the need for protection. Dislocations create tactical opportunities. So, how the macro environment evolves, I think, will always be a factor in terms of what is relevant for investors at any point in time. A bit more high level than that, I think it would be very interesting to see what the impact of AI will be in the space. I guess with the evolution and the speed of growth and the accessibility of AI tools, it's not inconceivable to think of a scenario where IP generation is quite commoditized. Signals and screening processes are actually very widespread. And if that is the case, or if that becomes more close to reality, then I guess the edge becomes even more implementation choices. It becomes even more the execution craft, liquidity, risk management, the strength of the platform, the flexibility. So it's a space to watch for sure.
And before we close, on a slightly more personal note, what has most surprised you over the course of your career in this part of the market?
I think it needs to be how different the space looks now versus when we started. So QIS has always been a business that is very data, technology, execution heavy. And what this has practically meant is that the investment in technology, in tools, in execution mechanisms, in implementation tooling has made QIS very nimble and very adaptable in different market environments. And while this adaptability was not necessarily the aim when building these platforms at the outset, it's definitely what has made them remain relevant and if anything, even more valuable, even as investors' needs have shifted time and time again. So I would say it's less about the one smart evergreen model, and it's really much more about the machinery that allows you to very quickly recalibrate and meet investors where they're at.
Chloe, thank you. This was a fascinating discussion. What I especially appreciated is that we were able to look at QAs not simply as a set of strategies, but as part of a broader evolution in the way investors think about portfolio design, implementation, and flexibility. Thank you again for joining me, and thank you to everyone for listening to this episode of Resonanz Spotlight. If you enjoyed the conversation, please subscribe, share it, and join us again for the next episode. Until next time.